Hey, it's Matty Mortgage. I'm back at it again. 2024 is almost up, and here's the last bulletin of the year to all those with the goal to buy, borrow, and build, whether that's right now, 2025, and beyond. So, what does the latest Fed cut mean to the mortgage market now that Jay-Pow and Company reduced short-term monetary policy by another quarter point? You know, the new rate may be only skin deep, but did you catch Jay-Pow's three admissions? I'm going to reveal all those today with the odds we see a housing crash next year. Time to face those ivory towers and break it down. Do you remember as kids taking a family road trip? If it wasn't that annual trip to grandmother's house, maybe it was the summer vacation. You know, the time to kick back, enjoy the scenery of somewhere else, eat some lobster, relax at the beach, and appreciate the change in season. All that sounds promising. The only problem? You got to get there first. So you pack your bags, your ice cooler, and you head out with the fam on Highway 95. Uh oh, there's traffic. A little more traffic, and you start to wonder, what time is it already? Are we getting anywhere? Your siblings already have to pee and you got to pull over. 15 minutes after that, the car starts to ask, are we there yet? Hey, Dad, maybe there's a faster way. Which reminds me of the latest FOMC presser. Sounds like the hot summer road trip. Chair Powell's driving the bus and has to answer these ridiculous questions, like if things are so great, why cut? Is the risk of inflation moving to the upside? You said deflation was the narrative. Why haven't we seen it yet? Some of these questions I follow, but sometimes the Fed isn't helping matters, answering that he doesn't know where the neutral rate is. Just like when he asks Dad, are we there yet? Dad answers kids, we left the station an hour ago, so we're 1 hour close to vacation, kids. That's how the ride goes. You sit down, you shut up, and you enjoy the back seat. Now, back to the neutral rate. Perhaps he doesn't know, or better yet, doesn't want to share with you. By design, neutral rates are somewhere between restrictive and accommodative monetary policy. And Powell's opening statement says something like, we've been moving on this policy towards a more neutral setting to maintain the labor market while enabling further progress on inflation. So, what does an economy look like with neutral rates? It's really hard to define, as that depends on many things. And why all the excitement on the number of cuts for 2025 when we know, not think, where we are now is still meaningfully restrictive. And Nick T from the Wall Street Journal asks if it's fair to assume that this is the last rate cut for some time. JP answers directly that it wouldn't be fair to assume that, as the Fed has been and always sees promises to move rates according to the data on inflation. In other words, the Fed isn't trying to anticipate the inflation rate, but read and react to it. The market reaction is likely temporary. The Fed hasn't surprised the market thus far. And the quarter point we discussed for this month was just as expected. Same with last month. Some may say that the September move was a surprise, but coming in 2 years after peak inflation, I think was appropriate. Yes, the Fed matters to the mortgage market, but the big picture is that the quarter point shift neither helps nor hurts the mortgage market directly. The quarter point's a drop in the bucket and confirms with the market what we already know. Inflation is coming down. Perhaps we give the Fed too much credit and too much emphasis on short-term policy when it's the forward guidance in asset purchases that may be behind the recent spike in mortgage rates. The Fed in the bond market's one conversation. The Fed in the mortgage market, it's entirely different. And most of these scheduled meetings do not help the mortgage market by and large. No matter if the measured move is a hike or a cut, and history's proven that half the time the Fed increases short-term rates, mortgage rates improve, and the other times when they cut, rates go up. Case in point, with the December Fed cut, and since the cut cycle began, mortgage rates are up. The change in the monetary policy means nothing for long-term mortgage rates. The sizzle rates have improved, but the stake is the Fed is reducing its asset purchases and may slow the pace of rate cuts in 2025. We all know the Fed's going to remain data dependent and going to switch gears based on what the new information says about inflation and the labor market. My opinion, I think mortgage rates trend down, but we don't see any significant improvement until Q4 of 2025. The next Fed meet is set for the end of January, and I doubt we're going to see any surprises over the next month. Unless we get a surprise meeting from the Fed in 2025, I'd pay more attention to the 250 plus trading days that could influence mortgage rates. Always best to be wary of the CPI, PPI, unemployment, and payrolls data. Sometimes we get some push or pull from retail sales that may move the market. And some people like to use the 10-year Treasury notes as a proxy for mortgage rates. The 10-year is a good barometer for the day-to-day changes, But note that sometimes the spread between them can be as low as 3/4 of a point or as high as 300 basis points. And I prefer myself to use a site like Mortgage News Daily because this site tracks mortgage coupons, and the coupons are a way better indicator of how lenders are pricing mortgage rates day to day. Now I want to focus on my Fed reveals from the December meeting. There were a few important admissions that are more critical to the mortgage market and real estate than the actual rate cut. For most people, the cut was what the market expected and what was delivered. And despite what mortgage rates have done recently, I think they're due for a reversal in 2025 based on the Fed's responses during the press. The first admission was that they're adjusting policy to the neutral rate. However, it doesn't know where that rate may land. And here's Fed Powell's admission in his own words.
Business. So you say that we're closer to the neutral rate. What percent do you see and the committee believes, where is that neutral rate?
So I'll say a couple things. First of all, when we write, the thing we write down in the summary of economic projections is the longer run neutral rate, which is the neutral rate at a time when supply and demand are in balance, the full economy is in balance, and no shocks are hitting the economy. That is not where we are right now. So when we're making monetary policy at the Fed, that's not the question we're asking. So you can't do a straight read between those longer run numbers that we write down and what we think the appropriate policy should be.
It's hard for the Fed to qualify the neutral rate. All that they can state right now is that they're not there yet. Meanwhile, the members of the media are shouting from the back seats, "Hey, are we there yet?" More important, the neutral rate may look different based on the stages or several economic factors. This admission led to several other great questions for Powell, who did a thorough job of answering all of them. The main takeaway is that they're nowhere near ending the rate cutting cycle. And as inflation drops towards the 2% target rate, the whole world will respond with cheaper interest rates. Chair Powell spoke in prior meetings that rates should return to normal. And where we are right now is nowhere close to normal. Also, the Fed mentions that the economy is strong. GDP growth is good, consumer spending still high, employment's moving higher, or unemployment's moving higher, but still within the realm of max employment. The only part of the economy where the recession is in effect is housing and mortgage. And here's an interesting chart to show what interest rates mainly have done to the mortgage market for the past 2 years. And some say this is 2008 all over again, which I would respond, no way, no how, because the business today requires a lot less personnel to manage. And during the pandemic, the business boomed, but so much of the loan process is automated, the business can do a lot more with a lot less. In fact, lenders prefer this type of business because it removes liability. No need for the backshop processing with all the automated income validation. There's less of a need for underwriters, with most of the underwriting done with a computer. No one in the business wants to put their name on it anyhow. This graph speaks to the independent channels of mortgage origination, but in the same philosophy, non-bank to bank originations. The client's doing more of the application. You're filling out more of the forms online. You're uploading the financials direct to underwriting. This makes for a more efficient process and keeps lenders with a higher profit per loan and reduces the actual production cost. It's deflationary and one of the many reasons why lending rates will improve in the coming year. My prediction for 2025 is that 5% mortgage rates will come early as the end of next year. Now, who knows where the Fed will be on the neutral rate by that time, but I still would not consider a 5% mortgage rate yet normal. The why is in the Fed's second admission. Policy is still restrictive today. And if the Fed doesn't know where neutral is, who cares if we're 100 basis points closer? It means that we still have a long way to go on this trip to grandmother's house. A part of the justification for the cut this month was that we're still in a rate restrictive environment. And as long as interest rates are restrictive, it makes sense for the outlook over the next 12 months to account for lower rates, even if at a slower pace. In just the last year, core inflation has been cut in half, and the Fed isn't going to stop cutting until we're back at that 2% target. I've given you my case for what neutral means to the mortgage market, but now let's talk about how the restrictive policy translates into housing. We're nowhere near a normal housing market because who can afford to sell in this market? The NAR identifies the late baby boomers as the beneficiary of this market. And if you just look at the stats, they're in their mid 60s, they're married, and about 80% of them don't have kids. Perhaps they've purchased their last big house and have the flexibility and equity to downsize. They're likely empty nesters and set to consume less. Now, this demographic is best set to sell their home And that's what the data shows. Now, the market's not so kind to the rest of the crowd because if you look at the affordability factor in what it takes as far as income to buy a median priced home in today's market, it's atrocious. And if you're looking to downsize now, who does it benefit more than the empty nesters? But you still have to be pretty strong to buy and sell at the same time in this market because you have to qualify or account for higher mortgage costs. And here's a chart of the mortgage payment just over the last several years. As long as interest rates hang out in the 6 to 7% range, the market is going to remain captive of the lock-in effect. And while at the same time, the market lacks a real first-time homebuyer participation, we're still underbuilt on housing stock. To what degree, nobody knows. But the higher these rates go up from here, the tighter the lock-in effect. Now, new money will reappear once the affordability index increases, or should I say the unaffordability index decreases. 6%, I don't think it happens. Even at 5%, it may get a little better, but I don't think the system really unhinges until we get mortgage rates into the fours. Now, maybe you know all this, but the last admission from the Fed came through a question from Elizabeth Scholes, and she asked Mr. Powell, these prices are still a burden. What can the Fed do about this? And JP basically responds, we know all this, and the best thing that we can do for them is to get inflation back down to its target, the 2% per year. Now, how are they going to do that? Big picture, they're going to need to keep people employed, and they're going to need to see real wage increases so that their wages are going up and their compensation is rising faster than inflation year upon year upon year. And that's their plan to restore faith in the U.S. economy. So there you have it. Don't expect prices to come down to wages. Expect wages need to increase to catch up to prices. Now, how long is this going to take in a market where there's limited housing inventory, high interest rates, and therefore a limited selling pool? I think the combination's promising for real estate over time, but how it improves is going to depend on a couple of things. We're going to need to see low unemployment, increased wages, lower interest rates, and perhaps some deflationary pressures outside of housing. Now, 2025 may be the start of that market. Here's Matty's mortgage and housing outlook for 2025. Crash talk is trash talk, and all you need to do is look at the fundamentals. I do think there's a good chance that wages do increase from here, especially if the labor market remains tight with unemployment at 5% or lower, and we continue to see healthy job creation on a monthly basis. Now, it's true, it's nowhere near the job creation we had in 2023 and 2022. However, the Fed knows this and will work together with the Trump administration to keep people employed and decrease borrowing costs. The sentiment toward housing, I think, has already changed and is only going to heat up along the year with mortgage rates declining by and large in the fourth quarter. I think it's a bumpy road until then, but I do expect the improvement to start towards the end of the year. As for home values, I'd expect another solid year of appreciation anywhere between 3 and 5%. Now it's time for the phony headlines. In real estate, you got to expect the unexpected. First two coming in March of 2025. Tides of March, strongest number of sales since 2022. And how about reach for the sky? Case-Shiller reports new high. Now, 6 months down the road, in June, expect, quote unquote, deflation's in the air. Fed follows pause with UFO size cut. And finally, better late than never. Mortgage rates now 5%. That's all I have for now. Have a very Merry Christmas and Happy New Year. I'll see you again soon.